What are the key risks that investors need to be watching right now during this period of tumultuous growth? Joining me today in a special three-way panel discussion are two very special guests, Florian Grummes, Managing Director of Midas Touch Consulting, and Bill Baruch, President of Blue Line Futures. Gentlemen, welcome back to the show. It's a pleasure to have both of you at the same time together.
Thank you for having me.
Let's start by recapping your viewpoints on the economy and setting the stage for what investors need to be watching right now. Florian, you've mentioned to me offline something called the crack-up boom, which is an economic theory stating basically that monetary collapse could be in the works, and a recession in the economy usually accompanies this phenomenon. Can you explain how this is applicable to today's situation?
Sure. Well, the concept of the cracker boom basically was discovered by Ludwig von Mises from the Austrian School of Economics 100 years ago, or even longer. And it basically says that the real economy is collapsing due to a collapse in the monetary system. And that basically is caused by the continual expansion of the available credit, basically. And that then will result in a rapid and unsustainable price increase, basically inflation. So what we're seeing at the moment, since the corona crash and lockdown, any central bank on this planet has expanded their balance sheet, has basically done massive credit expansion. And at the same time, the economical activity has been going through down to the cellar. So there's no, I think we can talk probably 25% of what we've seen economic activity in February to what we see at the moment. Restaurants are barely having a capacity full of 25% maybe. Airlines have at least a maximum of 25%. So, and at the same time, a massive expansion of the available credit, and you see rising stock markets, you see rising precious metals markets, you've seen cryptocurrencies rising. Everything is rising due to this credit expansion. And this is not sustainable, and there's no way out for the central banks. In fact, the market will always ask more and more cheap and easy money. And this will just continue to move faster and faster and faster, and it's basically a spiral. There's no way out. And the markets for a long time already have been become addicted to more and more cheap and easy money. And I think the game is just moving faster and faster. And we've seen this already the last 2-3 weeks. The Fed has injected 60 billion per week. And then the week later, it was already 10% more, 66 or 67 billion. And this is going on in every country with any central bank. And I believe the cracker boom is a concept that very well describes this and basically is an answer to all these questions that you now have, because most of the people don't get these rising stock markets together with the dire fundamental picture.
Now, Bill, you've also spoken about credit expansion and monetary stimulus. 2 months ago was the last time I spoke to you, and you mentioned then that we're about to see economic reality hit when data comes out. We've seen poor data come out, very bad data in the last 2 months. Why have equities not really reflected this reality? Why are we still seeing stocks near February highs?
Well, to the Federal Reserve's balance sheet has continued to expand. I think that's very supportive to the market. As Florian had referenced, the market's becoming addicted to this. It's requiring more and more. As a trader, as an investor, as a portfolio manager, you want to fight you don't want to fight the path of least resistance. And there's been some really interesting technical positioning that's moved the market higher. So not just the Fed liquidity, but obviously hearing the news about retail investors, and I think there's a phenomenon with call options that people are now looking for leverage. So when call options are bought, the institutions selling those options then have to turn around and hedge the risk by buying the underlying. So it's feeding upon itself higher. Now, is this wrong? No, the market is always right. You never want to fight the market. Is it surprising to see the equity prices elevated to this level? Absolutely. I don't think there's anybody out there that would have expected to see the NASDAQ make new all-time highs on the heels of a complete shutdown globally. So I think that, again, there's a surprise out here, but I think you have to take it in stride and not fight the market either. The economic data just this week we've seen retail sales month over month increase quite a bit. I mean, it's a really strong number, but year over year it was still down 6%. I think the job scenario is much better than expected too. So we're starting to see that the complete dismal data start to recover back. And it's going to be interesting here over the next 1 to 2 months to see where it goes from here.
Yeah, where do you see short-term momentum, Bill, just from a trading perspective?
From a trading perspective, you got quadruple witching on Friday this week, and that I think is a big event. As I've discussed here with the options already, you're seeing a lot of call options, record open interest in call options, and this is going to cause an unwind. All those positions that were then hedged positions, everything's going to be unwound. I think it's going to cause pressure in the market. However, some of that pressure may have been relieved already, as you've seen the a sharp sell-off on end of last week. And overall, I think this is the new normal. I mean, I think volatility is the new normal. And is that healthy? No, it's not a healthy bull market in order to see volatility as such. But again, this is the new reality. And if you're going to trade it, if you're going to invest in it, you have to not fight what the path of least resistance is.
Okay, Florian, Bill just hit the nail on the head here. To not fight the path of least resistance. Would you agree with the markets at this time? What's your personal sentiment on the risk return ratio that you're seeing in the equity space?
I totally agree with Bill. I mean, don't fight the Fed. It's that simple. And that's an old saying. It's nothing new, but just don't do it. So anybody who's trying to short this market is getting burned. It just doesn't make sense. They print so much money. Just don't do it. If you don't believe in these elevated stock market prices, then go to the sidelines and do something else, but don't short the markets. Only if you're a really, really experienced short-term trader, maybe you can do this, but as well, I wouldn't recommend it because as Bill concretely said it, path of least resistance is higher. So I think risk reward for the equity markets, I wouldn't be surprised to see also a stalling on these high levels for a few weeks, similar to what we've seen in gold. Gold has been the first one running out of this meltdown, the Corona meltdown, and is now consolidating for 2 months. So I wouldn't be surprised to see something similar maybe in the equity markets. But overall, I think they will also move higher, and I would buy any dip.
Mm-hmm. We're going to talk about gold in just a minute, but just to follow up, Florian, could you potentially see any way that the Federal Reserve could stop printing money in the next year? What could stop them?
I have no clue. I mean, it could be that there is a new law or somebody, or they just destroy the Fed. But any other than that, I couldn't imagine. No.
Bill, what do you think? The Federal Reserve just came out last week announcing to keep rates near zero for the next 1.5 to 2 years. What's your take on it? Could they possibly reverse this decision?
I'm not surprised to see them push out an analysis saying that they're not going to raise rates till after 2022. You can't get the full effect of what they've launched here, these unprecedented measures, if they're going to start talking them down. So they can't open that door just yet. However, I do think comments yesterday from Fed Chair Powell as he began his congressional testimony alluded to dialing back some of the purchases as the economy is on a more stable footing. That's to be expected. Now, the question is, when could this really start to happen? And I don't think they're going to change their narrative to any drastic degree prior to the July meeting. However, I do think as we look through June, we've seen the data come in a little better. I think overall it may not expand in some areas as we've seen from these dismal conditions in July as we've seen in June. But I think we could stagnate a little bit, but the overall economy overall improves or the uncertainty is relieved. So I would not be surprised as we look to the September meeting, late August, you start talking about some of the measures being dialed back. But that's different than stopping the measures altogether. So I think they could dial back purchases. And I do expect the economy to begin growing at the end of Q3 and have a very strong Q4, one that would start speeding up that process of then raising rates potentially next year.
Okay. Now, Bill, 2 months ago, you said that $2,000 gold could be in the cards by the end of the year. You just mentioned that economic recovery is expected to speed up by the end of the year. Would those be conflicted, do you think? Or are you changing your forecast?
Absolutely. stated like that, it is conflicting. And to now, as a trader, an investor and a portfolio manager, every single day you have to buy back the positions that you carried from yesterday. So,
Sure.
I continue to do analysis each day. And ultimately, this is not a secret that gold tends to top out August and September, goes through a dull period, October and November. And then one of the best trades every year is buying gold the second half of December, riding that in January. It's a tremendous trade. So I think our timeline in seeing gold break out and hit 2,000 this year is getting smaller and smaller. Now, we could see comments from the Fed. We could see the economic data turn poorly as from where we are now, turn poorly over the next 2 months, and gold could still get to 2,000. I do believe that the path of least resistance is higher for gold. I think it's technically building a great floor right now, 1680 to 1700, and I do expect that we can see a move out above 1800. However, I think in this year, I think we've started to see potentially that ceiling be lower a little bit, and whatever surge we get above 1780 may be the last little bit of surge here before it comes in a bit, and really the volatility slips out very sharply from the second half, or much of the second half of the year into December. But I think the first quarter of next year would be a very, very great time for gold, and that's when I think we would achieve 2,000 and above.
Okay, Florian, do you agree with Bill's forecast here in the medium term? What are the macro drivers behind gold prices that we can expect for the rest of the year?
Well, I would say what he just said, like first quarter next year, gold at 2,000 is probably likely. I don't see it happen this year anymore. I would expect gold to be strong into midsummer. So once this 2 months consolidation is over, gold should move to 1,800 and then maybe even towards the all-time high at 1,920, where I expect definitely another pullback. And of course, early November, you have the US elections. So this, I think, is the most important date that we can foresee for the next few months. And usually gold is weak before these elections. So I would say September and October, probably more time to be a little bit reduced exposure to the precious metals.
Last question for both of you. We are seeing rising geopolitical tension around the world. Just in the past week, Chinese and Indian troops have clashed along their borders. North Korea is deploying troops along DMZ. What are some of the major risks besides what we talked about in the economy that investors should be looking for right now? And how would you be allocating your assets for the remainder of 2020, Q2, Q3, Q4? Let's start with you, Bill.
Yeah, I do think that I'm very more surprised. I guess I'm more surprised that in a time right now, and I do want to start saying this with the positioning coming out of the June contract expiration, I was expecting gold to really find a move here in June once that contract fell off. And I'm surprised to see the volatility slipping out of gold right now. But it hasn't done anything wrong at all. However, it has not reacted to these geopolitical scenarios. And I think that is a little bit of a concern. But they haven't really heated up to an extreme degree. And if they were, that would be the catalyst that really takes gold out above 1,800. So I think the geopolitical scenario is always a very, very relevant situation that could be a catalyst for gold. I think as well, silver is something that you got to keep an eye on too. That I want to mention that there is some really great technical setup there with the 50-day moving average getting close to 200, and that could also be a catalyst for gold if silver can really start to get going and get out above $19. But again, I am very surprised to see the more dull reaction over the last 24 to 48 hours this week, given some of the situations between North Korea and South Korea heating up, and then more specifically as well, China and India clashing at the border.
Right, Florian, how are you positioned?
Well, I'm buying any dip in Bitcoin and in gold. And I have been buying some of the gold mining stocks on their recent pullbacks. So currently, to give you a few names, I look at Newmont. They are down 20% from their recent highs. Cisco Gold Royalties down 17% from their recent highs. SSR Mining down 20%. America's Gold and Silver, a smaller company I like too, also down 20%. So these are the things I'm looking for to get positioned for the next run in gold. Nobody knows when it will happen exactly. I think, from my experience, I can tell you, usually before the next leg up, gold is doing everything to shake off all the weak hands. So another final pullback towards and below 1,700, maybe 1,680, maybe even 1,660 will probably scare enough people that then suddenly gold takes off towards 1,800. and you want to be positioned for that move. I agree with Bill. Silver looks very well, really good. I mean, it has had a 58% rally, I think, from the Corona lows. And all it does is basically consolidating on very high levels without retracing too much of that rally. So I think also silver looks very well. Unfortunately, most of the silver mining stocks haven't had a larger pullback that I would like to buy. So I would like to see at least a pullback of 20%. I think only Sabina Silver would justify with a pullback of 25%. Most of the others are still holding up well.
That's fantastic. Great thoughts from both of you, Florian and Bill. I appreciate you both coming on the show today and sharing your thoughts. Thank you very much. To the viewers watching, Kitco News will be covering the Mines of Money Online Connect, which is a virtual mining conference coming up later in the month and early in July. Stay tuned for our coverage. And thank you for watching. Stay tuned for more.